Welcome back to Halftime Report. Jefferies lowering its price targets on internet stocks, saying beware the macro storm. Names include Amazon, Expedia, Uber, and more. It's our call of the day. Josh, you actually own two of these, Amazon and Uber.
Yeah, Amazon looks good relative to the rest of the market right now, only because there's a split coming up on June 3rd, which I think is Friday. So if you talk to a lot of retail investors who are excited about the split, it's a big one. It's 20 for 1. So I think that has helped the stock recently, but this thing has just been absolutely annihilated already. And so has Uber, which leads me to ask the question, did we miss the storm? Like, another storm? Like, we're in the storm. So I'm not really sure exactly why all of the negatives that are already in these stocks need to specifically get worse or have the price action get specifically worse. I'm not convinced.
Well, I mean, the thrust of it sounds like, Stephanie, the analyst is trying to adjust estimates for what he is seeing as softening macro conditions. And I think that's a question for the overall markets. Have we re-rated on earnings? I mean, we had Mike Santoli talk about the forward P of the market being, what, 16 or something like that? And is that neutral? Is that undervalued? I mean, where are we? What is that? And it's in the eye of the beholder at this point.
Absolutely, and it all depends what the E is going to be, right, Melissa? So if the macro is slowing, do you think these companies can deliver? So far, earnings have held up, but we went from 21.4 times forward estimates on the S&P 500 in January to right now about 17. Can we go to 16? Can we go to 15? The long-term average is 16. Certainly, we can overshoot. But see, on these stocks, on the internet stocks, there are really some great companies now that are down so much. And I agree with Josh. Did we miss something? I mean, seriously, Expedia, which I own, down 29%. They actually beat in the quarter. Their bookings numbers, their lodging bookings, rose 10% versus 2019 levels and up 20 times or 20 points since January. Their business absolutely is getting better. The visibility is very strong. EBITDA margins, this company has a lot of bloated costs embedded in the company, which they're fixing. So it's kind of a special self-help story as well. And so to me, I mean, the thing goes down every day, but I think that there's some value there. But this is a market right now that doesn't want that. This is a market that does, back to Brian Belsky's point, wants the dividends, wants the AT&Ts of the world. And so I'm just going to sit with this one because I do like the long-term fundamentals very much.
Yeah. Lebenthal, do you agree with what Jefferies is doing? Oh, okay, Josh. You want to intro? Okay.
I'm sorry, real quick.
You put aside Candy Crush for a minute?
Yeah, just I did. The macro is slowing deliberately. Like, this is the whole point. So if there is a macro slowing, the question to ask yourself is, does Uber Eats and Uber Rides continue to take overall share? Probably yes. Does Amazon e-commerce, Amazon Web Services, et cetera, take even more share?
But that's
probably
a growth
yes,
at all
but a
cost
macro
mentality,
slowdown
Josh.
means,
right? I mean, that's a growth at all cost mentality, which investors do not want in this market.
No, it isn't.
Okay.
It's not growth at all costs, because one of the things plaguing Amazon stock and Uber stock is a concern about higher labor costs, higher input costs, supply chain that can't meet demand. If you get a macro slowing, that's what cleans those things up. You're not going to have you're not going to have that problem of a too tight labor market if you substantially slow the economy. So I'm not saying like it's great to have a slower economy. I'm just saying it takes less pressure. It puts less pressure on the cost structures of these companies, which frankly is one of the reasons why these stocks have been selling off to begin with.
And this is the poetry of this all. It goes back to glass half full, glass half empty, Jim Lebenthal, because you slow the economy down and the labor force gets worse, and the consumer feels it and doesn't spend on Amazon. I mean, it goes full circle here.
Yeah. Look, that's absolutely right. And when you raised that point earlier, I said it's all about sentiment, okay? It's what people believe is going to happen. Either they're fearful of a recession, and that's why they're selling not only Uber or Expedia, but also the airlines and also the hotels and also the gaming stocks. Or if you're bullish like me, you think this is a mid-cycle growth slowdown. And before everybody starts arguing with me, let's just acknowledge we're not going to know until we're looking in the rearview mirror, okay? But if it's a growth slowdown that then will accelerate into 2023, then all of these stocks and the other ones that I mentioned will do just fine. So you as an investor need to make up your mind and do your analysis about what you think's happening with the big picture. I am bullish.
Joe, I want to quickly go to you because we're out of time. But you know, in my notes, it's a really interesting comment. From a technical perspective, I'm in a really bad position with Amazon. What do you mean by that?
On April 1st, I bought it at $32.75. Can you pick a worse buy? I think I'm down like 35% on the stock. So I could make any fundamental assertion regarding what I think is going to happen. Well, it was also added at the end of April to the Joe T ETF. So I'm sitting with my hands tied until the next rebalance. Hopefully the market experiences exactly what I said to Brian Belsky before, where you get a little form of a mean reversion. And a lot of these stocks which are in a bear market, which Amazon certainly is, are the beneficiaries of that. And at that point, you begin to reduce the position. But awful call on my part, bad buy, and stuck in a bad position. It happens.